Getting straight to the management of Kalpataru Projects. The stock is buzzing. Remember, they won orders of around 3,800 crore rupees. Mr. Manish Mohnot, the Managing Director and CEO of Kalpataru Projects, comes into the studio. Hi, Manish. Thanks a lot for coming down and congratulations on this large order. Well, give us a few details with regard to this project. What kind of margins are you looking at? Explain to us the two segments as well as geographically, how is it split, the 3,800 crores?
Good morning, Nigel. And fabulous studio. I've come here after a long time.
Come more often.
Yeah, I'll do that for sure.
That you'll have to win a lot more orders.
We will do that. So the orders which we declared today morning are approximately of 3,800 crores. Right. It involves a very large order with a large real estate developer based in southern India. The order pertains to northern India of 12 million square feet plus.
Got it.
This is a second order of 10 million square feet plus, which we have got in the last 18 months. Typically, historically, we used to do orders of much lower value when we were, two different entities. But today, with such high volume available, we're among the top 2-3 in the country doing 10 million square feet plus.
Yeah.
So out of the orders, one significant order is that. There are two more orders into building and factories, one in Western India, one more in Northern India. Mm-hmm. And there are some orders in the transmission space.
So what is the margin typically of this, and how long is the execution period?
So typically the margins for all of them range in the range of 9 to 11% at EBITDA level, right? From execution perspective, majority of this are 2 to 3 years, and some of the buildings in this large order go for closer to 4 years.
And since we started by inviting you more often because we expect you to win a lot more orders, just talk about that. What's your overall order inflow guidance for this year? And when at the start of the year you gave us that number, did it include this 3,800 crores, or this is over and above what you had spoken about?
No, okay. So to be very frank, it included the 3,800 crores. We had no clue that we would get it so sooner.
Got it.
So if you look at us, right, in the last 3 years, our order book has doubled. We were at 30,000 crores. Now we are at around 65,000 crores at the year end. Okay. For the current year, we have guided for orders in the range of 28 to 30,000 crores. While we speak, we already have got in excess of 6,000 crores in the first 2 months.
Exactly.
I do not see much challenge in making sure that we get this 28 to 30,000 crores. For us, more important is that profitable growth and working with people who we believe are the people we want to sustain long-term relationships and making sure we can deliver this kind of order in the defined time frame.
Okay, all right. So let's focus on a couple of aspects then, since you mentioned that profitability is something that you're focusing on. I understand that you're looking at your mix, revenue mix changing in such a way that your PBT will improve. Yes. So tell us, what is the mix you're looking at in terms of an ideal mix? And also, what is the PBT guidance you could guide us for?
Sure. So, Nigel, if you look at KPIL today, approximately 45% of our order book is international, 55% is domestic. So, one, we are looking at a well-diversified order book, both on domestic and international.
Yes.
Second, we are across 6 segments, right? But if you look at the last 18-odd months, we have been focused a lot more in transmission and B&F.
Yes.
Because you see a lot of opportunities coming in there. For us, it's very important to make sure that we deploy our resources where we get our maximum profitability. So that's why B&F and T&D in a big way. Okay. Now, margin improvements is happening across the board for 2 or 3 reasons. One, there is so much work. Second, there aren't many large-scale EPC contractors who are doing this kind of projects.
Yeah.
And third, our presence across 6 segments.
Yeah.
So with all of this, we're expecting closer to 50 basis points margin improvement in the current year in standalone. But on console, we're looking at closer to 100 basis point improvement in the current year.
And on PBT?
On PBT.
All right. And since you spoke about the merger and how, the consolidated entity has led to improvement in the order book, etc., what proportion of cost synergies have already been realized and how much more can come? Because you said that on a consolidated basis, your margin improvement would be a lot more.
Sure.
So that, I believe, underlines a lot of synergies there too.
I think cost synergies to a great extent has happened, right? Okay. It has happened not only in terms of, let's say, improving margins, but it has happened in terms of improving our design engineering skill set, getting that merged entity which becomes mechanical, electrical, civil, doing large-scale projects, all of that. So to a great extent, we have done that. But right now, the margin enhancement is because of the great order book. Right, and continued focus on large-scale projects with repeated clients.
Okay, all right. Another focal point, that we look at is cash flows and working capital cycle as well. And you've pressed on that point as well. I think the working capital cycle days had improved in the last year.
Yes.
So for this year, what is the working capital cycle days? And since you'll have unlocked some value in some of your projects, also you'll raise money by the QIP, interest costs came down. Interest costs as a percentage of sales is something that you look at. So throw some light on working capital days as well as on interest costs as a percentage of business.
Sure, that's a brilliant question because that's very close to our heart, right? We manage balance sheets as Marwadis, like very close to our heart, right?
I'm a Marwadi here, so I understand
that's something very close to our heart. So for us, net working capital days always have been below 100. Forget that COVID year, right? So that's been a target on a standalone. We came down below 100. We are targeting closer to be 90 in the current year. On console, we are closer to 80 days.
Yeah.
I believe it should only come down. Right? interest costs as a percentage of sales for the last 10 years have always been lower than 2%. And we are among the, I would say, the topmost in the industry when it comes to interest costs as a percentage, in terms of being the lowest.
Yeah.
Current year target is how do we reach closer to 1.75%, right? We're driving that. But as far as all of us are concerned, the focus is net working capital, 90 to 100, interest cost below 2%. And we're going to drive that across the organization.
As a percentage of standalone or console?
As a percentage of standalone, it would be that much. As a percentage of console, it will be much lower. Much lower.
So this 50 basis points margin improvement that you're talking about, one supposes that 25 basis points comes in from the improvement in your order book, and the other 25 basis points comes in from you reducing finance costs as a proportion.
I would say 40 and 10. Interest cost reduction, 10 basis points, right? Because a lot of it has already happened. QIP money came in into December and things have started. But a significant portion comes in from the new order book and focus on execution in a big way.
You know, and because of the QIP funds, your net debt is down to sub 2,000 crores. You spoke about being Marwadi, and both of us will have to ask you this question. We pride ourselves on being net debt free as well at some point. What is your debt repayment plan here? And with the kind of order book that you have, with the kind of cash flows that you will generate, I'm sure you would look at deploying that into debt repayment as well.
So net debt at the year end was around 1,100 crores. Right? At a standalone level. At a console level, it was about 2,000 crores. The difference between standalone and console is primarily road boot assets and some investments in international. So step by step, road boot asset, one of them, we have already signed off a binding agreement. We're expecting approvals to come into Q2, which would mean a reduction of closer to 700 to 800 crores on totality basis. On a standalone, while it would go up the first 2 quarters, typical cycle of business, but it would gradually come down. Also important to know, in the last 3 years, we put in more than 1,000 crores on capex. We built a balance sheet because it was visible that there's so much opportunity coming in, and we've used cash to do that also. So where we are on net debt, I think 1,100, 1,500, whatever, considering growth, whatever comes in is there. Yeah. But a lot of it would come from non-core assets, whether it is on Indore real estate, which we sell off fully, whether it is on VEPL, which we have already signed a binding agreement, and you'll see a lot more money coming in from there.
And the execution, I missed that number. Revenues for this year, how much higher will they be in comparison to last year?
So we're targeting a minimum of 20% in terms of revenue growth, standalone and console. But given the kind of orders coming in now, we will target much more. Let's wait for Q1 results and see that if we can do higher than 20%.
So 26 to 28,000 crores was what you had targeted at the start of this year. You believe that you will stick to it, maybe perhaps the higher end of this range if things fall into place.
Yeah, I would say more closer to 28,000 crores.
Okay, since you've come down to our studios, we always press for big places, big occasions, big numbers. You have your order book at closer to 65, 66,000 crores. When do you get to 50,000 crores in revenues?
3 years from now, definitely. See, our biggest challenge today is not order book. It's not capex. It's not balance sheet. It's availability of labor.
Yeah.
Right? Because the biggest challenge the entire industry has is availability of labor. Yeah. So while we want to grow at 20%, we want to make sure we don't compromise on margins. We don't compromise on a commitment on delivery. And that's why growing at 20% is good. Targeting 50,000, definitely. We've come here, but maybe give us a window of 3 odd years and we should be there sooner than later.
All right, Manish, it's a pleasure having you in the studio. Thanks a lot for joining in.